to resume. Perfect. Right. I think we're ready to go. And like I said, more people are on the way. So obviously they'll be coming in as and when we kick off. Right. So brilliant. Really, really pleased that we can do today because crowdfunding has been something which has been really important part of my life probably for about 10 years. I've invested in numerous different businesses with varying success. So, I've kind of seen it all. Michael will give the kind of warts and all 101 in a minute, really, in terms of crowdfunding and why potentially it's a good option for your business. But then also look at it from both sides, the benefits for the business, the consumer, and just generally, obviously, anything that you need to know about this. Um, so we'll do this. As I said before, Michael is the ex-commercial and ops director of Crowdcube, pretty much the leading kind of crowdfunding platform here in the UK. They also help people raise investment across Europe and I think maybe potentially even further afield now. He's also a fractional growth officer. So again, big into kind of growth and helping businesses grow. He'll talk a little bit more about this towards the end of the presentation, but he is operating across AI, sustainability, fintechs right now with a real kind of like broad kind of overview of those as well. So just so we can do this before we kick off, and you're going to basically listen to me kind of talk for ages and ages about this. How we've kind of run it on previous webinars is that if you have questions, please do pop them into the chat. I mean, there's two options. Either keep them till the end when we have our Q&A section. If there's something that's relevant as we go on, please do basically pop them into the chat box. And when I think it's the perfect time to just bring them to Michael's attention, then I can do that. So obviously you've got the option to do those both ways. We also have some questions that have been put forward by some Nexus members who couldn't attend today. So we'll obviously be bringing those points up as well later on in the Q&A session. So like I said, it's going to be a really impactful, really exciting kind of Nexus Masterclass today. And Michael, over to you.
Awesome. Thank you very much, Johnny. Okay. 96 seconds. Now, that's how long it took Monzo to raise £1 million on Crowdcube in 2016. That's roughly about £10,000 every single second, which is completely mental. I suspect most of you know who Monzo are, founded by Tom Blomfield, the same guy who co-founded Go Cardless, and once joked that he had Mark Zuckerberg on speed dial. Whether that was true or not, I don't know. But they are famed for their coral cards, their enviable customer experience. And I guess in many ways, they're partly responsible for bringing in this kind of new dawn of customer-focused banking. The round that I was talking about there, the £1 million in 96 seconds, at that point, it was the fastest equity crowdfunding round in history. But a few years on, again on Crowdcube, FreeTrade beat them. They raised £1 million in 77 seconds and £5 million in just under 4 hours. So both of them obviously went on to break future funding records with much larger follow-on rounds as well, I suppose. Quick one. Has anyone got a Coral Monzo card in their wallet? Drop a money emoji in the chat if you've got one. So why am I telling you all of this? I guess in short, because I managed both of those raises on Crowdcube, and like Johnny mentioned, I was part of the team that gave birth to equity crowdfunding here in the UK back in 2011. Feels like a lifetime ago, really. But I spent 8 years at Crowdcube and led the commercial and operations side of the business. Worked with about 1,300, 1,400, I think, startups to pull in about £1.4 billion and lots of names that you'll know. Guys like Revolut, FreeTrade, Chip, Chilango, Adzuna, JustPark, Podpoint, Citymapper, BrewDog, and then, of course, Crowdcube itself. We raised 3 times on our own platform and with venture capital investors all the way up to Series B. Now, I'm not at Crowdcube anymore. I should point that out. So I'm not speaking here in an official Crowdcube capacity. I'm more going to give you an overview and like Johnny mentioned, a bit of a kind of warts and all view on whether it's going to be right for you guys and what you can do. So I do and have done a couple of other things. I started a B2B fintech, a B2C fintech, and I've run a consultancy and have raised quite a bit of money myself, raised from investors like UBS, Lakestar, MasterCard for my own companies. So I guess I've worn hats on both sides of the table. But beneath those kind of flashy 96 seconds and 77 seconds, there was months and months and months really of kind of meticulous networking, planning, investor choreography, and lots of that is what we're going to go through today. So let me take you through the agenda. So the next 40 to 45 minutes, we're kind of going to bounce from some data to war stories, a few mini polls. So I guess, not just a talking head. So I'd like you guys to be a little bit involved and see Johnny's getting involved with his little chat emojis. From my understanding, about half of you haven't raised investment before, and maybe half have dipped a toe. So I'm going to avoid any kind of insider jargon, and we'll talk through some of the key terms you might need to know. Keep that Zoom chat open. We'll have time for questions at the end, and I guess Johnny's already covered that, so you know what to do there. But really, the idea is at the end of this, you should have a pragmatic view of where crowdfunding sits in the funding ladder, how long it really takes and what it involves, a view into some case studies, and then lastly, a kind of step-by-step checklist to hit launch with confidence. That's the plan. So have any of you guys raised external equity, any equity investment before? Stick yes, no, or currently raising in the chat if you have. I think that would be really helpful just to get a feel for where everyone is. Okay, we got a no. That's cool. No, great. All right. Then this next session is this next little bit, the funding snapshot, is probably going to be quite helpful for you guys. So let's anchor ourselves first and foremost in the 2024 numbers and what the funding landscape looks like. So venture capital first. The BVCA pegged total 2024 VC investment in the UK alone in British startups at around 9 billion. So a healthy 12.5%-ish up year on year. Although 2023 was a pretty shaky year, but it kind of proved there's still dry powder confidence in UK tech, in UK funding. So flipping to the crowds. Bowhurst, which is the kind of Bible in the UK here for private equity investment. They log all of the deals. They logged 297 crowdfunded deals, about 324 million. So I guess in one sense, that's actually the smallest volume since 2014. But it's still about a fifth of all of the announced UK equity investment deals. So it's still meaningful, even in a cool-ish market. And I know from chatting to the guys that it was a difficult time, 2023, and actually kind of coming out of the pandemic in particular. So zooming out, Europe cleared about 45 billion for the full year, with London still the single busiest hub. Some good context, really, when you're hearing about US billion-dollar deals and mega rounds and this, that, and the other. MVCA, their yearbook put the total US VC at around 160 billion in 2024. So over half of global venture dollars. I guess in other words, we're still pretty small fry compared to the US, but we're still one of the largest venture markets in the world. So this one, particularly for you guys who haven't raised investment before, these are 5 terms really, a kind of jargon detox before we plunge deeper. I'm not gonna, there are millions more terms, but I would say if you know these 5, you kind of cutting 90% of the jargon and fluff that might come up in an equity investment round. So pre-money valuation, it's basically what your company's worth just before a check lands, and then the post-money valuation adds the check to the cap table, so what it's worth after the round. So just to give you a real simple example, say you're raising £2 million at a £6 million pre-money valuation. Because you're raising 2 million, 2 plus 6 equals 8. 8 million is going to be your post-money valuation. And for that, you will have sold 25% of the equity in your company. So 2 as a figure of 8, you can see where that 25% comes from. So using those basic numbers, it's quite simple. Now, we talked about dilution. Dilution is just simply the slice of your pie shrinking as you bake in new slices. So if you own 60% pre-raise, you might drop to 45% afterwards. But the pie itself is growing, or the pizza itself is growing. So you're getting a smaller slice of a bigger pie. Share classes, retail investors on Crowdcube or Republic, and two of the big platforms which we're going to talk about, will usually get ordinary shares, and they'll be grouped under the nominee structure. I'll explain a little bit more about that later. But VCs will typically demand preference shares. So they sit on top of the waterfall, if you imagine, like a stack of investors that get priority. Your preference shares sit on the very top, and basically it means they get their money back first in an exit situation. There's a couple of others, and you may have heard of platforms like Seed Legals. They did a really good job of bringing ASAs, advanced subscription agreements, to the fore. But convertibles or ASAs, they basically are IOUs. That's the best way of describing it. So an investor would wire you cash today. Typically, it would be debt at that point, but at a later date, it would convert into an equity round, say, at a 20% discount or a capped valuation. And those are really handy for bridge rounds or grabbing quick investment while you polish a crowd campaign or need to get to your next metric or market without giving tons and tons and tons of equity away. Now, last but not least, here is the UK's secret sauce, and this is tax relief. SEIS stands for the Seed Enterprise Investment Scheme, and EIS is the Enterprise Investment Scheme. They're really, really impactful tax reliefs that have helped a lot of companies for raise funding here in the UK. So let me give you an example. An angel investor or an investor in your company invests £100,000. Now, assuming they pay UK tax, if you have SEIS tax relief, they can claim half of that back. So 50% of their investment, they get back. It basically gets taken off their tax bill. And they'll also pay zero capital gains tax if you exit big enough. So it is a huge incentive for people to invest in early stage investments, and you should plaster it all across your deck. It's really easy to apply for. SEIS is 50%, and typically for much smaller companies. EIS is 30, and based on kind of company age, funding to date, and a few other stipulations. Okay, so funding routes. Where does equity crowdfunding sit? So before we dive into equity crowdfunding, let's just do a quick pit stop on the other funding lanes so you can kind of get a bit of reference for where it sits. Now, in no particular order, bootstrapping, I'm sure it sounds like lots of you guys are doing that right now. That's either revenue from your customers, your own cash, your credit card, your mum, your dad, anyone else who you can get money from that you're not giving away equity for. It's slow, but 100% ownership is a beautiful thing. And if you can bootstrap the whole way and it doesn't slow down your journey, why on earth wouldn't you do it? Grants. So in the UK and Europe, we're kind of talking about Innovate UK, the Horizon Europe grants, R&D tax credits, local LEP funds. Really, this is non-dilutive cash. You don't have to repay. It's not a loan, it's a grant. The problem with this is that the timelines are really slow, and it can be quite a lot of work to actually get these grants done. There are lots of grant writers around that can help you out. They'll normally take a percentage of your kind of successful grant award. Probably one for another conversation. You've then got angels and kind of the SEIS that we talked about. So friends, family, fools, that's what FFF stands for. These are normally your first external checks, could be 5K, could be 250K. A lot of it is kind of motivated by passion there, emotional decisions, believers in people, also tax relief, and I guess the warm glow of helpful builders. And then you've got equity crowdfunding slotting in next. We're going to go into a lot more detail about that, but it's turning the crowd into equity investors. Think of it, I guess, as a megaphone that broadcasts your business to thousands of mini angels, your customers, and often kind of institutional investors and VCs, other angels and larger angels as well. And then you kind of graduate beyond that to seed VCs, So VC venture capital writing bigger checks, 1 to 5 million. And they'll bring patent recognition, some board meetings, probably liquidation preferences. And then at the very top end of the spectrum, you've got strategic or corporate venture capital. So PE players maybe, and they'll show up when revenue traction is a lot clearer, their money is larger, but alignment can be a lot trickier typically. And you can kind of see a graphic here of where this might sit in your journey. So it hopefully will add a little bit more context around round sizes and timelines. I'm going to be honest, everything blurs a little bit. This makes it look like it's really black and white and quite simple, and you just go from step to step. It doesn't quite work like that, particularly based on geography and industry. Things can be a little bit different. So before we jump into equity crowdfunding 101, which of these routes that you're looking at here for you guys feels like the logical next step? Just dump it in the chat there. I can see a few people typing. I'll have a little peek in a minute. Alrighty, so onto the main event. Hopefully that context was helpful. Now let me talk about the mechanics and give you my kind of basic explanation of what I think equity crowdfunding is. So you would apply to Crowdcube or Republic. You would create a pitch, which is then vetted, and you'd need to prove everything that you say publicly. So any numbers, statistics, awards, anything that you're claiming that you're going to put in front of investors, you have to prove that via due diligence. And in many ways, it's actually not too dissimilar to the level of due diligence required for an IPO. And that's because primarily this is going in front of retail investors, and that's who regulatory authorities are most concerned about. So IPOs and the due diligence required on crowdfunding in terms of proving what you're saying is true, it's not too dissimilar. Now, you would complete all of the documentation, your deck, your video, warm up your network, and then you'd go live. And once you're live, retail investors, like Johnny, actually, he's done some investing, so he'd have to go through a certification process. They'd either self-certify, or they'd say they're a high net worth. They will watch a risk video, and then they can commit to invest anything normally from about £10 upwards. So it could be £10, could be £100, could be £10,000, could be £100,000 if you're really lucky. And the SEIS, EIS relief, identical to a direct angel round. It'll be displayed on your pitch. HMRC doesn't really care whether it's one check or 10,000. It's absolutely fine. So you'll go live, and we're going to talk way more about the live process and the pre-prep process and other things. So this is just a real whistle stop. But once you're live, you hit your funding target, you then go through the legal completion process, and there's a cooling off period, platform dependent. It's normally about 7 days. And then the investment is captured from those investors, and it will land in your bank account. Now, you might be wondering how these investors are investing in your company and freaking out a little bit about hundreds of thousands of individuals on your cap table. Well, fear not. Typically, shares in the company are issued via a nominee structure. And what that means, if you imagine a direct shareholding method, you might have 10,000 individuals all investing individually, and they would all sit on your cap table as 10,000 individuals. Now, that can be a real hassle to manage. So a nominee structure is basically just a group. So there will be someone who heads the nominee, and it will be a single line in your cap table, and all of those investors will sit underneath that one nominee. So it makes it a lot more simple for you to manage. You're not having to send 100,000 emails or 10,000 emails or worrying about that. All of it goes through the individual nominee, and that can all be managed on a multitude of different platforms. I know Crowdcube and Seeders both have their own kind of proprietary tech to do it. So sounds simple, right? It's not quite as simple as it might sound, but we will get to that later. So Another quick Zoom poll. Stick a thumbs up if you or anyone you know has ever raised money using equity crowdfunding. That can be on Crowdcube, it can be on Seeders, it can be in the US, it can be anywhere in the world. But if you know anyone who has, it would be really interesting to see a thumbs up. So, what do founders rave about? Now, there are plenty of upsides to raising money via an equity crowdfunding platform. And I'm going to go through a few of them. They're probably distinct based on the type of company you are, all of which are, I guess, the only one really that isn't there is this access to capital. So it's the most obvious one. It enables your business to raise funds by tapping into a more diverse pool of investors. So not just angels, not just a small group. You're talking customers and broader people who you may never have come across in kind of your day-to-day walks in life. So there's one big plus, the marketing halo. No doubt many of you will have seen headlines in Sifted, in TechCrunch, in AltFi covering the round. So in essence, there are lots of ways of getting free PR, but this is a really strong one, particularly for consumer brands. The real superpower is that your customers literally buy in. So FreeTrade CEO Adam Dodds, he called the crowd vital in spreading the word after their record round. And that leads on pretty nicely to kind of community building. So investors are more than just funders. They kind of become loyal supporters. They'll provide regular feedback. They'll promote your brand. You look at the guys at Monzo, there's about 35,000 investors. They still shout about the bank's features how many years on, what was it, 2014, 2015, 2016, like nine years on. I've still got my, I was a Monzo investor. I've still got my Coral card with investor on there. And in contrast, no one's talking about their VCT holding or anything like that. So there's a big kind of enhanced loyalty play. And I think investors as customers are much less likely to churn to competitors and way more likely to refer new customers to your business as well. So that's another big plus. Streamlined IR. So the nominee that we're talking about consolidates investments from everyone, and it makes it really simple to manage. Even more simple actually than doing an angel round with 20 or so angels. It's really simple, it's really easy, and all the platforms facilitate that. And then the last couple, market validation. So the response to a crowdfunding round or a crowdfunding campaign, I guess, is a really good test for your product, your business model's market validity. You're going to get a lot of questions, you're going to get a lot of eyeballs. And if you can have slightly kind of tough skin with that stuff, you get some really good insights and feedback to how a huge volume of people are going to want to pick apart your business model. And that can be really valuable. Even though someone's investing a tenner or 100 quid or 500 pounds, they could still be a really smart individual with some really good insights. So there's definitely some value there. Last but very much not least is the kind of secondary liquidity play. And this is a newer piece amongst both Crowdcube. They have CubeX and Republic also run a monthly secondary market. And so these are kind of ad hoc auctions, no guarantees, but you can come back and utilize the secondary markets, raise again, or sell some equity. Some of your shareholders can sell some of their equity as well on these secondary markets. So those are the goods. I'll be honest with you, this is a slide that never appeared during my time at Crowdcube. But it is the reality. So all of the platforms, they all do it everywhere around the world. They'll trumpet their win rates, but often this isn't the reality. So Republic, sorry, will tell you that theirs is an 88% success rate because they vet deals hard. But the reality is they don't let you launch until you've raised a significant amount from your own network. There was a 2023 study that went out and reviewed kind of the global market data on equity crowdfunding. And the picture was a lot more kind of sobering. Industry-wide of businesses that launch and go live on equity crowdfunding platforms, only about 40% actually succeed. So the success rate, you're more likely to fail than you are to succeed. Hopefully, though, by the time you've got to the end of this presentation, you have a reasonably good feel about what you need to do to be equity crowdfunding relevant business and how you can prep. So the timeline is another one. A lot of people think this just happens in a month or two. It doesn't. Fundraising, typically, they say it will take you 6 months. This actually isn't that different. It's just done in a different way. So the median journey from first contact to cash in the bank is 6 months. 4 months is the bare minimum if it goes absolutely rapidly. And the more complex your legal structure is, the more existing shareholders you have, various different rights that they may have that will need to be negotiated or consolidated with crowd investment. That's just going to push out the timeline more and more and more. It's not free, so budget. Typically, the success fee on these platforms is somewhere between kind of 6 to 7%. What they don't tell you is that you can negotiate that. But there's 1%, I think, on one of the next slides. I'm going to give you the full detail, but it's about 1% legal nominee charges, and the platforms will recommend that you spend about 10% of your investment round on marketing. So that's ads, that's video, that's PR, that's getting things out on social. So if you are wanting to raise via the crowds, do come and have a conversation with me, because I will definitely be able to get you a better fee deal through my backdoor routes and all of the people that I still know. Okay, and the last hard truth, and this can be the most painful for people that don't succeed. And the reality is that 60% of people that ever try and raise is, if you miss your target, the whole world sees, right? You literally have to click withdraw with the whole world watching. It's not fun. If you're going to go into this and you're going to have a crack at it, make sure you're pretty damn certain you're going to be successful. And I'll tell you how to do that now. So, is equity crowdfunding right for you? We're going to do a bit of a self-diagnosis here and go through what I deem to be the 6 ticks. While I was at Crowdcube, I built a machine learning algorithm that we basically went through every little scrap of data we could find to try and understand what the trends were that made equity crowdfunding pitches successful on Crowdcube. Some of these are more weighted some of these are more weighted than others, but broadly these are the 6 kind of takeaways. The first is, do you have an audience, right? B2B API startups are rarely successful. Really, consumer fintech, consumer products, all of that type of stuff, it works really well. People need to be able to, the layman on the street needs to be able to understand your business. If it's something really deep tech, really complex, you're just not going to get the breadth of people that can understand it really quickly, really easily. So secondly, have you locked down your pre-registrations? Do you have soft commits from angels that you've met, from customers, from funds, from VCs? Without this early momentum, you're basically never even going to get a public pitch. And on Republic, that's definitely the case. Crowdcube are more likely to take a chance if they think there's something there. But the reality is that if you can't raise from your own network to start with, you're never actually going to make it live. Third is about the story. So can you pitch this mission in one tweet? And can you make people actually care about it? Lots of these investors are going to be investing from a crowd perspective on this kind of emotional resonance. Are they moved? Do they understand it? Do they get it? Are they excited by it? That's a really critical one. Fourth, do you already have validation? So I'm talking about awards that you might have won, customers growing really quickly, revenue that's existing, revenue that's growing, strategic investment, partnerships. What you're looking for here is mechanisms for people to look at your pitch and say, oh, wow, that de-risks this investment for me. If they have X, Y, and Z, that must mean they're a good business. And you'd imagine people are going to go into depth of details. Some people are just going to put small amounts in because a venture capital company they recognize has invested, or someone's on the board, or you won an award that they know about. if some of the other ticks are in place. Fifth, we talked about this loads, tax relief. Tax relief is pretty critical. This was the standout driver for success on Crowdcube. It was the #1 thing. Without tax relief, it's pretty hard. If you're going to raise any type of investment here in the UK, you're gonna need it anyway. It's pretty quick and easy. So crowd or otherwise, get going on that if you're going to start raising. And then 6, last but not least, do you have the time and energy commitment? If you can't commit 6 months to this, it's going to take over your life. It's going to take over your business. Then don't do it. So you have to believe that outside of this just being about money, there's significant more upside for this to be worth the time and effort commitment. So in the little chat box, let me know what your tick count is between 0 and 6, and be honest. Be honest. Tell me your ticks. Now, let's tell you a little bit more about the platforms. So I'm going to focus on the 2 biggest platforms in Europe, and that's Crowdcube and Republic, who for my whole career I knew as Seeders, and it's really weird calling them Republic. So it's not Coke versus Pepsi. I am a little bit biased given my background, but both platforms do nominee custody, which we talked about. Both will passport into Europe under the new harmonized regime. Both of them have pretty standardized due diligence. It's going to be pretty hefty. They'll also be doing AML, KYC. They both have cooling off periods. Now, Crowdcube boasts the bigger retail community. I think it's at about 1.7 million now. And a lot of B2C brands will often lean there. Now, Seeders, Republic, they have a much slicker and better secondary market. The fees there are marginally lower. So for larger rounds, sometimes people will go that way. Although saying that, I think 19 of the largest 20 rounds in the UK have used Crowdcube. I think either way, however you kind of look at it, you got to treat the platform like a stadium. You still got to sell tickets to fill the crowd. And that early part is all about you. So let's dive into a few wee case studies. Now, I've touched on Monzo. I forgot to mention why I put up their Mondo card at the very start. So Monzo was originally called Mondo. Those of you who don't know, Tom used to work with the founder of Starling Bank. And during the lead up to their campaign, they forgot to register the web URL. So their competitor Starling stole it from them. So they were originally called Mondo, but had to change it to Monzo because they didn't own their own web URL, which I thought was pretty funny. They didn't think it was that funny at the time. But Monzo's journey is a classic crowd as an amplifier. So they raised that million in 96 seconds. They raised round 2, 2.4 million in 2 hours. Round 3, 20 million in 2018. They've got over 36,000 investors or 35,000 investors now, and each round of theirs became a big PR event. It widened the funnel for their current accounts, and by the time Y Combinator and Thrive Capital led their 85 million pound VC round, brand awareness was through the roof. So there's a couple of lessons here. It's that crowdfunding multiplier. They basically locked in an existing customer base and then utilized the kind of drive from their existing customers to grow and grab more customers. But they didn't use Crowdcube to grab a customer base from scratch. The second lesson is they basically left nothing to chance. So their fundraisers went really quickly. They planned for the very worst case scenario across all of their raises. They had a day by day, hour by hour Gantt chart for exactly what was going to happen when, who was going to be doing what, who the owner was. Even if, even though I think they were kind of 95% sure that they had all the money lined up anyway, they didn't leave anything to chance. And I'll tell you the type of things they were doing a little bit later. Quick stop into FreeTrade, although I am going to do the third case as one that's probably a more typical journey. So I'll spend a bit more time there. So like I said, FreeTrade, they've raised now about 29 million pounds through Crowdcube. They've also got 34,000 investors. I think they've raised they've done 10 fundraisers, which seems a bit nuts to me. Quite a few of those since I left. I think the early raises, what they did well was utilize their retail or prospective retail investors. These guys who either were customers already or on the wait list kind of doubled as brand ambassadors. So their referral approach increased their user growth by about 500%, and this was all person-to-person referrals, like pushing people into their wait list. And this buzz, they created a lot of buzz from this. It coaxed institutional money, right? So Draper Esprit invested in their Series A few months later, and a lot of that was to do with the kind of retail base validating or providing proof of their product market fit. One of the things that Adam Dodds and the team did really well there, the rest of the management team, they used their network incredibly before the raise. So they were pretty sure they had the 1 million pre-committed and created this kind of FOMO to get their friends and other people in their network clambering over each other to invest. This is much more the typical fundraise. So this is what I would call a kind of everyday example and not the outliers of FreeTrade and Monzo. So this is Skin Analytics, really cool platform, an app that helps people to understand whether or not they've got melanomas that are cancerous, basically. So they raised £514,000, I think, from a couple of hundred investors towards the back end of 2015. And I'll talk you through this cadence. And I've seen this time and time again. So you will see a big opening week. Pre-commitment, all of the pre-registrations that you have, that will start to land. It will then slow down noticeably during the middle of the campaign. And it's pretty critical you keep the interest with news updates, even some kind of pre-committed investors at this point, to keep the flow going. The founder of Skin Analytics was out at pitching events, at investor events. He was doing meetings, he was doing calls, he was doing a ton of stuff. Every day he was involved and he was trying to convince people to come over the line. So there was a lot of time and effort that went into getting that middle period to continue to tick upwards. And then towards the back end, some of the work that he did landed. So the Duke of York got involved. London Co-Investment Fund also invested. And then at that point, there is a rush at the end because investors have to make a decision and they don't want to miss out. But it's very front and back end weighted with a really hard period in the middle. I have an ecosystem and kind of architecture for how you manage all of these things. I have template documents and thousands and thousands of examples of how this can work. So I'm very happy to share that with people if they are going to go and raise a crowdfunding round. So what does a round look like? What is the 6-month roadmap? I think really it's split into 3 sections. What you need to do before the raise, what you're doing while the raise is live, and then what you need to do after the raise. So these timelines are there or thereabouts. They can be plus minus 2 weeks, normally plus and less minus, but you need to bank on it being about 6 months. And I'm going to pick all of those 3 sections apart one by one and give you some kind of tips. So before going live, your kind of pre-launch checklist. What do you need to get ready? So the very first thing is you need to make sure that you meet eligibility criteria. I believe Crowdcube still require a UK limited company. If you are in the UK, EU company, it's a little bit different for pan EU and there are US options as well. But certainly in the UK, you need at least 2 directors, you need existing revenue, and you need sufficient runway to make it well beyond the end of the raise. So you can't be running out of money in 4 months' time. You need to be capitalized at least 3 months past that 6-month time frame, which is often challenging. So you're going to need to agree your valuation early. The best way to do this is with existing angels or VCs or a lead investor, and I'll explain why a little bit later. Ideally, from from your customers, from your lead investors, you want to be covering at least half of the raise. The way to do it really is to set a slightly lower target and then overfund. You will need to build momentum as well. So this is creating a landing page, gathering pre-registration, so setting up a wait list, talking to your community, your customers, your friends, through email, through all of your existing, whatever your best marketing channels are, that's where you need to be engaging them. You are going to need to spend some time crafting your pitch deck. You're going to need to record an engaging video. It's going to need to tell your kind of mission-led story. The story is really critical here, and it's going to showcase your traction, your team, and everything that is going to excite people about your raise. Part of this, and the often forgotten part, is that you need a pretty robust financial model here. People are going to be investing money in your company. They need to understand that you understand the financial aspect of your business. And they also need to know that you've got some rationale for how you're going to spend these funds, where it's going to go. This is all going to get scrutinized. You're going to line up embargoed press releases. You're going to plan your marketing in advance so you can hit the ground running once the campaign opens, and you are going to prepare every single aspect of the content for the live part of your raise before it goes live. This is writing updates. This is preparing forum responses. This is all the social posts. This is your scheduled emails. All of that gets done before, so you don't have to worry about it when it's live. You can focus on engaging with investors. Okay, so press play when the round is live. So let's say you are in a private, you've gone private to start with. And typically this is the way that most platforms will do it. It is in part up to you, but it's what we would recommend. So you're not sitting there on 3% and no one's coming to invest. You push your pre-registered community to get to 50% and then you go public. When this opens to the public, you are going to run a marketing blitz. You're going to go bananas across email, across social. Your press is going to land. And you need to keep this energy up by posting quality updates. I always used to recommend at least 2 to 3 a week. Remember, you're going to have all of these pre-written beforehand for the whole duration of your platform. And you need to expect that you're going to get that lull in the middle of the campaign. So preload it with interesting news, like keep some things back that you might normally have shouted about on social media, so you have enough interesting stuff throughout the public section of your campaign. You are going to actively engage on the investor forum, respond quickly, keep the tone positive, keep it informative. Remember, the forum may be the first impression for potential investors, so lots of them will go there first to see what people are asking. Last but not least, all of the platforms have a dashboard. You can email your followers, you can email investors through there. You can apply UTM tags like you would on social media to track traffic, and then you refine your outreach on that. Last but not least is about just creating this FOMO. So thinking about, you've done the marketing blitz, how are you now going to use your progress to date on the platform to create FOMO externally and internally? Okay. So you have hit your target. Firstly, congratulations. You are, you've done a pretty stellar job by this point, and I expect you're pretty exhausted. But investors at this point will enter a cooling off period. It's about 7 days, at the end of which funds are collected, and the investment becomes legally binding. But you'll need to send out at this point the articles that are going to form your constitutional documents and any other investor agreements. It might be a shareholders agreement, it might be a nominee agreement. And after this cooling off period, if you are in the UK, you're going to send out something called an SH01 at Companies House. You'll need to file that, and then you'll need to issue share certificates to all of your new shareholders. I would strongly recommend sending out a welcome pack. You'll need to kind of pay out any rewards and get all of that stuff sorted. But it's a really good idea to start to build a really good relationship with this crowd, this investor base, because they can be leveraged for years and years and years to come. And to that point, keep them engaged. Send regular updates, quarterly at a minimum. It might be nice in the early stages to do monthly, cover things like milestones, sales figures, product development, and ask for help. Ask people for help. Ask these guys for introductions, for insights. And just, I would recommend being transparent about how things are going. Don't tell people everything's rosy if it isn't. They can't help you if they don't know what the problems are. So clear communication builds trust, and it'll help you if you go back and want to raise a future round. So the second last slide, just a quick one and a couple of pointers. I'm going to go through some pitfalls. The FCA lumped investment-based crowdfunding into its high-risk bucket in 2023. You need to be mindful of this. That shouldn't put you off. The platforms will run you through what you need to know. But every retail investor basically now has a personalized risk warning, a click-through quiz. And the critical change is they need to wait 24 hours before they can invest. So there are a few other changes. Refer a friend bonuses are banned. You can't do that anymore. It has reduced the platform conversion. I think is about a fifth. You need to kind of build that attrition into your funnel maths when you're thinking about how you're going to plan your raise. Now, lastly, my kind of don't fail pitfalls and pro tips. Now, hopefully, we should have covered most of this in the upsides. And I'm going to kind of re-refer some of this back to you because these are really the critical piece. Why do people fail? The first and most common reason is because they have no network, they haven't pre-funded investment from their customers, angels, VCs. There's a saying out in the investment space that empty restaurant syndrome lives strongest in equity crowdfunding, and it's so true. If people aren't investing in your raise and others look and see that there aren't people in there, no one is going to, because they're wondering what's wrong with it. If you hit 50% of your round, you have an 80% chance of being successful. Second, planning for all in eventualities. So do a Tom from Monzo, have everything done before your round goes live, and plan like a maniac. Leave nothing to chance. Third, marketing spend. We talked about this. So top quartile raisers spend 10% of the round on ads, video, PR, deck design. Underspend, and I think you'll probably flatline. Fourth, valuation. So crowd investors use the same, I guess, kind of heuristics we'd call it. If you're twice the sector multiple, you need to expect a lot of pushback in the forum. It will kill momentum. The best way to validate your valuation is externally with a VC, with like a seed angel or someone that carries some weight that isn't just you. Fifth, you're not investment ready. What does that mean? So do you have the right traction to get people excited? Are you in a growth phase? Do you have industry awards? Do you have any good press and PR? Are there skeletons hiding in your closet? This will get found out at venture capital level. It normally may be missed at angel level, but the crowd will scrutinize you. So you need to make sure you're investment ready. You need to make sure that you have traction. Comms is the second last one. So during and post raise, I've talked about this, I've banged this drum, but it's so important that you are quick with your responses. The number one complaint on Republic is that people don't reply to forum questions. It's the same on their secondary market. Keep updates after your funding round. People are not going to invest in your business again if you've not communicated with them and just taken them for granted. And then last but not least, the one that unfortunately you're not going to be able to change is fitting the equity crowdfunding mold. I've said it works best for B2C companies. This rings true. You need that excitement. You need that emotional appeal around the product, around the vision. Emotion plays a big part. So you've got to have that. And if you don't, it may not be for you. That doesn't mean you can't raise funding. You're just going to be better getting it from more relevant sources, be that angel investors, be that deep tech VCs, be that grants, whatever it might be. So, whew, feel like I need to have a lie down. There was a lot to go through there. And I appreciate you guys trying to take in a lot of information. I am going to send you this deck, I believe. Well, I'm going to send it to Johnny. He will share it on.
I will.
What I will say is the best way to get hold of me, the place I'm most likely to reply is on LinkedIn. You can scan that QR code, find me on LinkedIn, send me an invite, and I am happy to have any conversations. If you just want to sense check whether it's right for you, I'm very happy to help. So I think we don't have 20 minutes, but we do have some Q&A time. So I'll hand over to you, Johnny.
Of course. And I just want to say, wow, Michael, I knew you were going to drop something really, really good today, but that was so detailed. And I think as well, you were very honest. Like you said, sometimes crowdfunding just isn't for those sorts of businesses at all. It might be that a B2B or deep tech might work if you have a massive, massive community or massive list or something like that, later on, I guess, in those stages. But
Yeah.
like you said, I think B2C and consumer is really, really interesting. So I did a bit of I don't know if this will hopefully translate to our audience here, but like some maths on the back of a fag packet before, and what you were basically saying before about how you can generate, spend money to make money basically with
Yeah.
crowdfunding. So say you spend £10 on adverts and you create a customer who maybe puts £10 in, you might think that's cost neutral. Oh, why have I done that? But
Hmm.
if that person has the loyalty to your brand and they spend £100 with you over that time, then obviously you've got a lifetime value maybe of £100. But of course, if
Absolutely.
they are super passionate about what you do and they've been treated well and they maybe introduce 5 people, well, there's £500 you potentially generated in terms of, downstream revenue that's going to come into your business.
Yeah.
So it is a long-term game, this with crowdfunding, and I think it's building those relationships. And for people who just think, oh, Cedars or Republic or Crowdcube charge 4% or
Mm.
6% or 8% or whatever the fees are, there's a value to this that obviously you're getting a lot more. It's about community building. It's about building up a mailing list. It's having that kind of almost built-in bank of potential consumers and people who love what you do. So
Yeah.
take the time, invest in it,
Spot on.
and go from there. But that was just my point anyway of what you were saying there as well, Michael.
Cool. No, you're absolutely spot on.
So we've got just a couple of questions here, and then we've obviously got some that have been sent in. So we'll try and rattle through them quite quickly if you don't mind, because
Cool.
I know some people might have to go because they have previous meets arranged.
No,
So
no problems.
got Hedy here who said, I'm curious about the timing aspect. Is it generally better to have some proven market traction before raising funds, or have you seen early stage raises work well?
So yes, it's definitely better to have proven market traction. I think that goes to that's not just crowdfunding. You're going to find it pretty hard to raise any investment apart from that kind of friends and family and really small angels. Without that, that being said, it has been done on Crowdcube before. You have to hit every other sweet spot, and you would normally have to already have a network. It may be that you are a second or third time founder, you've exited, and people know that you can do it. So there would have to be other traction points. If you are a first time founder, you've got a really good idea, but you don't have traction yet, I would say hold off on the crowdfunding. It's gonna take a lot of time and attention. Go and find some angel investors that can really help you in those early days, that can give you kind of one-to-one strategic advice. Find some advisors, find some mentors, and get people involved, get that traction, and come back when you can use it to accelerate your business rather than use it to grab traction in the first place, because more often than not, that's not going to be successful.
Yeah, I think that's really good advice, to be honest. I think crowdfunding is an incredibly good tool, but use it as and when it just makes sense for you. What we'll do is because we've got some great questions coming through, so as long as you're happy to answer them and you've got a little bit more flexibility
Yeah,
in
I've
the
got
area,
I've got
Michael,
time. I can answer. That's no
we'll
problem.
do them. We'll do the middle way, not super quick, but not super long, so we can hopefully get through them out a bit more detail. And then hopefully most of our audience can stay. Obviously, we're recording this, so again, we
Mhm.
can share this with people later on as well. So just from Hedy as well, following up on that, it says, what's your advice for founders on managing dual demands of fundraising and business ops? How do you prevent the company from stagnating while you're spending months pitching to investors? And I think this is quite good for you because obviously you've got your ops head, but you've also got your growth head and
Yeah.
investment head. And look, this is the same for crowdfunding in any investment. You know what it's like. You go fully all on in, and it can be this. And we're probably thinking about founders who haven't got a big supportive team. So, what's your advice here?
Yeah, firstly, it's really hard. I think my advice would be if you cannot commit 100% to the raise, and you don't have some support there that can help keep the business ticking over, then it's probably not right for you at that point. You're probably better off waiting a little bit longer, until you've at least got a management team around you, people that can take some of that slack, because it's near enough impossible to do both. One is going to suffer. Either you're not going to raise the funds because you're going to need to spend time in your business, or your business, if you're a kind of sole founder doing things on your own, or your business isn't gonna kind of move forwards in the way you would like it to. There's another potential option for smaller raises. There are a multitude of people out there that can be the ops person in your raise. If you search for Equity Crowdfunding Support UK, you'll find. I know Crowdcube partners with some of them. They can kind of be a plug-in plus one, to help you during the duration of the raise. It's not free. They're going to do it normally for a success fee and a small retainer. But if you can afford that, do it.
Wicked. That's really, really good advice. Yeah, it's a constant battle, and you just have to understand what you can do and what you can't do. Plan ahead and obviously try and make sure that you can keep the wheels spinning, but try not to take on any extra projects as well. Don't basically be thinking, oh, we're going to test out this brand new marketing campaign or something in the middle of doing something like this, because
Yeah.
I see this from traditional investments as well. It's just full on meetings, working so many different hours on trying to close the deal. But of course, then you extend your runway for 18, 24 months or something like that. It's obviously all worth it. So definitely worth going for. Right, Catherine's got a question here. You mentioned 40% success rate earlier. How are we defining success? Is it successful meeting of the funding target, or does it include percentages of firms that return the value back to the investors?
Yeah, so this came from an external research company that looked into all of the European equity crowdfunding rounds, and what they looked at was equity crowdfunding rounds that had gone public. So this isn't this for this 40% is not companies that have returned or exited or generated investor returns. It is 40% of companies that have made it to the live phase of their campaign, so they're visible to the world, are then successful. In short, that 40% success rate means that 60% of companies are unsuccessful. Now, the platforms will try and mitigate this basically. So they will tend to not want any failures, which is why Republic talk about this 88%. What that normally means is that you work in the background, but your pitch never sees the light of day. So there are probably more failures beyond this. I would say in my time at Crowdcube, when I left, I tried to calculate it. I think that I worked with about 14,000 businesses, and only 1,400 had successfully raised money. So there was a lot of conversations going on with a lot of people who either got part involved or didn't make it, or whatever it might be. So yeah, that's the reality. Not everyone is going to be successful. I think if you learn some of the lessons and take some of this stuff on board, you've got a much better chance. And it may be that it's just a not right now, or in 12 months this is going to be right for me, or in 18 months, or in 6 months, or okay, I know what I need to work towards now to get myself in a position to be ready to raise investment and reduce the chance of failing pretty significantly, so you don't make it into that 60% that doesn't hit their target.
Yeah, I think that's great advice. And what I probably would say to anybody, I don't know if Michael covered this, but one of the best ways you can learn as a founder right now by planning ahead is to potentially go on to Republic, go on to Crowdcube, and follow businesses that are potentially in your industry or other ones. You can follow their campaigns. Even you might want to put a tenner in, so you're basically getting the inside track on how they communicate with their potential audience, their potential investors, their future investors, seeing what their schedule is like, what content seems to resonate. It's a really good way for you to get real life action about what's happening, plus the industries that are actually raising and what's successful right now. They're both open platforms. You can go on them even without, I mean, obviously we just said we have to do the due diligence to be accepted as an investor. But it's a great way in real time to get that and then start maybe even putting it into a Dropbox or whatever, like the campaigns that have worked the best, what's happened for them, and then potentially, you can borrow their ideas themselves. Right, Jan Mar's got a really good question here. Thank you as well, Catherine, for that question. Is the business model of a B2B SaaS software system for SME owners, such as HR, suitable for this financing model? Basically, they've said because SMEs, the purchase decision and user are usually the owner. So this is very B2B, but definitely worth looking at if you wouldn't mind answering that, Michael.
Yeah, sure. So just there's probably some context for this. Can you tell me a little bit more about the business itself? Just like a real high level one. Do you know, Johnny?
I don't right now because I know Gian's is basically starting this. So I don't know if you want to put a bit more information into
No,
the
that's fine. So we're
sphere.
we're we're going to talk about B2B SaaS, SME owners. Um, I would say you're not in the sweet spot, but it's not, it doesn't sound to me like that's going to be something so complicated that people can't understand it. I think what you will find and what we do know is that a lot of people in the crowd are either startup founders or understand the pain points of small businesses. So it may be something that can resonate with those guys. Regardless, you're gonna need to have your own network engage with that. So all of the other requirements ring true. You're going to need to have an engaged network, either an engaged customer base or the ability to call on prospective investors. If you can do all of that and people can still comprehend your business and your model, and it sparks that story, that emotional appeal, then I would not at this point say that you're definitely not suited. I would like to know more, and I can probably give you a steer. If you ping me on the sides on LinkedIn. I'm very happy to give you my honest opinion on it and kind of give you what I think would be the framework you'd need to get yourself into a point where you can raise.
100%, 100%. Let's just go through a few more. Catherine's back on. Do you see issues in the target amounts set by owners? In other words, are firms more likely to fail if they set targets that are basically unrealistic, too low or too high? Also follow up with this is, um, fail meaning failing to launch a successful ongoing business. So I guess that's it. I mean, I guess just reading between the lines, I sometimes see businesses go on and they look like they're failing. And then all of a sudden you're like, oh shit, they seem like really good. And then all of a sudden they're out of business 6 months later and everyone's like, oh, right, they've pulled the wool over people's eyes. So, you know,
So there's been plenty of those. There are plenty of those in all types of equity investment, in angel investment as well. There are a couple that I remember that made waves. Sugru was one of them. It was like a huge pitch, really good female entrepreneur, and then the finances of the business just fell apart. So when I'm talking about failing in this sense, in the sense of the pitch, the kind of deck that I've just delivered to you, I'm actually talking about failing to reach your funding target. So I'm not specifically saying that a business who fails to reach their funding target or does reach their funding target is necessarily guaranteed to go on and be successful. There are plenty of examples of businesses that were unsuccessful on Crowdcube that went on to be a success. They just weren't quite the right fit, or it wasn't the right time or right circumstances for their business. And unfortunately, the other side of that is true as well. I think one thing I would say is that Crowdcube in particular, 78% of the companies that have ever raised on Crowdcube have either exited or are still going, which is a complete role reversal to what the kind of age old adage people say, which is that 80% of startups fail. So yeah, there's some interesting pieces there. What was the first half of that? The target bit, wasn't
yeah,
it?
too
Okay.
low, too high.
Yeah, 100%. And there was a really, I remember there was a really kind of odd phase that we went through with the FCA about this, and they kind of changed the requirements because at Crowdcube the founders realized that actually if they set their target really low and then they hit 100% and overfund dramatically,
Mm.
they believe they could kind of garner more investment, and there are tons of examples of that. Now the FCA kind of stepped in and said, okay, you can't artificially set like a, I don't know, £1 funding target and then raise £100 million or something mad. That's a crazy example, but you get my point. So setting the target is pretty critical. With any of your account management and the sales team that you'll work with on these platforms, they'll talk a lot about this, and a lot of it will be, okay, what do you actually need? You can't set a target that doesn't meet your business plan. So if you are to hit £150,000, but actually you need £250,000, you can't set £150,000 at your target. So it needs to be the minimum you can do to execute your business plan, even if it's kind of executing on a slightly kind of bare bones. But you're right. Setting too high a target, you set £1 million target, and then your network is able to bring in £200,000. You're pretty unlikely to hit that target. So it does go both ways. The bare minimum needs to be executing your business plan with the funds if you hit your 100% and no more. Don't go too high, or you'll never be able to leverage your network to actually hit your target. And then this may not be have been obvious, but if you don't hit your target, you get nothing. Like you don't get what people have committed, you get zero. So you have to hit your target, otherwise you'll get no money at all.
And I think that's fair. I think, obviously, we talked about this earlier on, you obviously
Mm.
have to commit, let's say 10%, like you said, in terms of marketing of it, getting it out there. Obviously, the platforms help you get out there as well. They're showing it across their socials, but there's nothing better than you also getting it out there as well. But obviously that cost is going to be, stuck, you're going to be stuck with that cost even if you don't raise anything. So make sure you do your work, make sure you do a proper job of it.
Yeah,
Hopefully get the sweet spot, but there's no point in you raising something where you're like, oh, well, this only gives us 3 months runway. Because you're going to be dead in the water anyway, without being harsh, unless you get a lottery win or something, you're not going
yeah,
to
yeah.
execute on your plan. So I think that's really, really important, what you said as well.
It will also be about 30 seconds before someone in the crowd realizes that. They're going to go through your financials and be like, hang on a second, this is going to get you nowhere. And then you'll look like you don't know what you're doing. So then it's game over as well.
Definitely, and I think this leads on to one question which I'll mention, which I'll ask in a second, just to wrap up as well. So, just want to thank everybody, obviously, for coming today. Really, really good questions, really, really great content. Looking forward to sharing the recording with everybody else. We did have a lot of people as well who couldn't make it, which I will share with them directly. Um, the next webinar that we're doing, I'm right in thinking, I think it's the 20th. Obviously, this is going to be on website design, UX, UI, a lot of talk about AI. Thank you very much for everybody who's given us some feedback about what you'd like to hear in the session. I have sent the type format on our WhatsApp group and also obviously on email as well recently. So, we're going to be putting something together very, very special. So keep an eye out for that. We'll get the registration link out to you next week, just having the resources done for that. So again, I want to thank Michael for coming in today. It's been really, really impressive. This really enjoyed it. You've got this LinkedIn QR here. I'll also put his LinkedIn direct URL in our WhatsApp group later. And maybe just a question to kind of put out there now to you, Michael, is, you mentioned right now about a few crowdfunding success. Sorry, let's say lack of success stories. Ones where they haven't worked out, or they maybe have raised and they've gone bust quite quickly.
Mm.
We're also seeing a few. You mentioned FreeTrade and BrewDog, I'm afraid, is looking like it's not going in a great place as a business right now because they've taken on, equity investment at a later stage, which is almost like, completely knocked out early stage investors.
Yeah.
As the market matures, like where do you see the future of crowdfunding potentially going in the next, say, 2 to 3 years? Do you think some of these stories and potential horror stories for the consumer is better because it means that the crowdfunding market will get their act in gear? Or, like, what do you think, or where do you think things are going?
Yeah, look, I think it's difficult. So in the very early phases, the architecture and the structure of deals on Crowdcube, on Seeders, it wasn't potentially as crowd beneficial as it is now. So there was a long learning process. You have to remember that when we started Crowdcube, when Crowdcube kicked off, there was no regulation. Like technically in 2011, we were we were acting in outside of the law. We were kind of, the FCA viewed us as cowboys, and we worked with them to build the regulations that exist now that govern online retail investment. And when that happened, there were benefits, and there were benefits for investors, and the FCA are really focused on investor outcomes because retail investors are the most, I guess, the least qualified is probably the best way of describing it. So the most likely to misunderstand online investment requirements, regulations, returns, and other things. So if you look at the success rates, and I talked a little bit about them, I think it's about 5% of investments on Crowdcube have exited. And there have been some really strong exits. The people at Revolut made almost 2,000% on their investments. And there were many millionaires made from that. The guys in eCar Club made a ton as well. And there are companies that have had significant amounts of crowd investment and not done as well. They've not generated significant returns. I think that's the same across venture, across angel investment. It's just kind of the way it goes. I think the difficulty was that prior to the nominee being the kind of standard approach, and to give them their credit, Cedars Republic, they had a nominee from day dot, and it was the right move. It means that the crowd are less likely to get worse outcomes, basically. That it's been the standard now for quite some time, and I think you're going to start to see that through the variety of exits that will appear in the next 2, 3, 4 years. But yeah, I'm gonna be honest. So we set out to do something which was to help small businesses that didn't have access to capital and access to a network, the ability to raise funds. And it hasn't worked out like that. What happens, the guys that this works really well for are sadly the companies that could probably raise money elsewhere anyway. And it's accelerated, it's created this crazy marketing opportunity, halo effect for those guys, but it hasn't really solved the problem for the people that always found it really hard to raise investment. Now it does, it's a lot easier now than it was in 2011, 2010 to go out and raise money. That there are some that make it, but it hasn't solved that long-term problem. And that makes me a little bit sad. Like those are the people I was most interested in helping. I think that the FCA do a pretty good job of trying to make this work. It's been a hard slog over the last few years for all of the crowdfunding platforms. It's been a pretty turgid investment environment generally, unless you're in AI and primarily in the US as well. But I think this year things have started to bounce back. I spoke to a couple of the guys in at Crowdcube, and like 2023 was a really difficult year for them. 2024 things started to bounce back towards the end, and this year they're already seeing a stronger year. So fingers crossed. I think it still can be a really valuable route for the right type of companies. I would just say be really wary about whether you are the right type of company. Make sure you go through those 6 ticks in the deck, and you're really clued up about what a crowdfunding round is going to look like and the best place to do it.
Wonderful. I think that's a really, really good point to finish on as well. We had the where we've come from, where we're going, obviously very realistic views about kind of like where the industry is at right now. But like you said, there are some kind of improvements coming over the last few years, which is really good. And let's hope that those improvements, Michael, are those ones that can really get in there and help, like those smaller businesses as well, because like you said, they're the ones ideally on the SCIS, potentially EIS, where it really, really helps as well. So, no, once again, I just want to thank obviously all of our guests. I want to thank yourself for coming as well, and also for obviously being able to take the extra time today, because I think the questions are always so valuable as well to everybody. Please
Absolutely.
do add Michael on LinkedIn. He is a Nexus mentor, which is brilliant. So, please add him. Don't be afraid to give him a quick shout for a call. He runs this brilliant kind of growth agency and, consultancy as well. So please
Yeah,
give him a
very
shout
happy to
regarding
help.
that if you need specific help. Anything else you want to finish on, Michael? You want to say?
No, I don't think so. Yeah, thanks. I really, really enjoyed it. Hopefully some nuggets there. And yeah, anyone who wants to have a conversation or get in touch, I can see a couple of people have already pinged me on LinkedIn. I'll happily have a chat. So yeah, thank you. Thank you for having me.
Sounds very good. Well, yeah, if you send me the deck on email now, I'll ping it in our WhatsApp group so people have got that, mate. And then, yeah, we'll just get it all closed up. So, yeah, thanks very much, everybody. Enjoy the rest of your week. I will catch up with you all soon in office hours. And yeah, take care. See you all in a bit. Take care.
Cheers,
Goodbye.
guys. Bye.